Welcome back to Smart Dollar Mindset, the channel where we help you build smart money habits, improve your financial knowledge, and create a path toward real financial freedom. If you're new here, make sure you hit that subscribe button because we're dedicated to giving you the tools and strategies you need to take control of your money and achieve your long-term goals. Today, we're diving into a topic that seems simple but can have life-changing consequences for your finances: minimum payments on credit cards. At first glance, minimum payments look like a lifesaver. You get your statement, and instead of owing $2,000, the card issuer says, just pay $35, and you're good. Sounds great, right? Wrong. Minimum payments are one of the most dangerous traps in the world of personal finance, and if you don't fully understand how they work, they can keep you stuck in debt for years, sometimes decades, while draining thousands of dollars from your pocket in interest. By the end of this video, you will know what minimum payments really are and how they're calculated, why paying only the minimum is the fastest way to fall into a debt spiral, how interest interacts with minimum payments to keep you in debt longer, real-life examples of how minimum payments can turn small balances into huge financial burdens, practical strategies to avoid this trap and pay off your debt faster. This is not just another credit card talk, this is a wake-up call that will change how you handle your credit cards forever. Let's get started. What is a minimum payment? The minimum payment is the smallest amount of money your credit card company requires you to pay each month to keep your account in good standing and avoid late fees. It's essentially the lender saying, pay this, and we won't penalize you. Sounds fair, but here's the catch: paying only the minimum doesn't reduce your balance much. In fact, most of your minimum payment goes toward interest, not the principal balance. So, you're paying the bank, but you're barely making a dent in what you owe. How are minimum payments calculated? Credit card issuers calculate minimum payments in one of two ways: a flat percentage of your balance, usually 2%, 3% of your balance. Interest plus fees. Some issuers require you to pay the interest due plus 1% of the principal. For example, if your balance is $2,000 and your minimum payment is 2%, that's $40. If your APR is 20%, about $33 of that goes toward interest and only $7 reduces your balance. At that rate, it will take years to pay off your debt, and cost you hundreds or thousands in interest. Why minimum payments keep you stuck in debt? Here's the harsh reality: minimum payments are designed to keep you in debt longer. The bank makes money from interest, and the longer you owe, the more they earn. Paying the minimum stretches your debt over decades because you're barely reducing the principal. Real life example: let's say you owe $5,000 at 20% APR, and your minimum payment is 2% of the balance, about $100. If you only make the minimum payment, do you know how long it will take to pay it off? Nearly 30 years, and you'll pay over $11,000 in interest alone. That's more than double the original amount you borrowed. On the other hand, if you pay $250 a month, you'll be debt-free in about 2 years and pay less than $1,000 in interest. The difference is staggering. The psychological trap of minimum payments. Minimum payments are dangerous because they make you feel like you're doing enough. You see the word minimum and think, if I meet this, I'm okay. But what you're really doing is renting your own debt, keeping it alive while giving your lender a steady stream of interest payments. This is why millions of people get trapped in credit card debt. They think they're managing it, but in reality, they're barely covering the cost of borrowing while the principal sits there like a mountain. Interest and compounding. The real culprit. Credit card interest compounds daily. That means every day you carry a balance, interest is calculated and added to your total. And then you pay interest on that interest. When you only make the minimum payment, most of your money goes to interest charges, which keeps your balance almost the same. This is why your debt seems to barely move even after months of paying the minimum. It's like trying to empty a bathtub with an eyedropper while the faucet is still running. Why banks love minimum payments? Minimum payments are profitable. Credit card companies advertise convenience and flexibility, but what they really want is for you to pay as little as possible each month, so they can charge you more interest. That's their business model. Banks know that most people will only pay the minimum because it feels safe and easy, and that's how they make billions every year. The true cost of paying minimums. Let's do another example. Balance, $3,000. APR, 19%. Minimum payment, 2%, $60 if you only pay the minimum. It will take over 15 years to pay it off, and you'll pay nearly $3,500 in interest. So, a $3,000 purchase ends up costing you more than $6,500. Now, what if you pay $200 instead of $60? You'll be debt-free in less than 2 years and save over $2,500 in interest. That's the difference between financial freedom and financial slavery. How minimum payments affect your credit score. Here's an interesting twist. Making the minimum payment on time will keep your account current and prevent late fees, which is good for your credit score. But it won't help your credit utilization ratio, which is one of the biggest factors in your score. If you owe a lot relative to your limit, your score suffers even if you're paying on time. To improve your score, you need to pay more than the minimum and bring your balances down. How to break free from the minimum payment trap. 1. Commit to paying more than the minimum. Even an extra $50 or $100 can drastically shorten your payoff time and reduce interest costs. 2. Use the debt avalanche method. Focus on paying off the highest interest debt first while making minimums on the rest. This saves you the most money in interest. 3. Try the snowball method for motivation. Pay off the smallest balance first to build momentum and confidence. 4. Automate payments. Set up automatic payments above the minimum so you never forget. 5. Avoid adding new debts. Stop using your credit cards until your balances are under control. Advanced strategies. Balance transfers. If you have good credit, transfer your balance to a card with a 0% intro April. Just make sure you pay it off before the promo period ends. Negotiate lower rates. Call your issuer and ask for a rate reduction. It works more often than you think. Consolidate debt. Consider a personal loan with a lower interest rate to pay off high interest cards. Minimum payments are one of the most deceptive features in the world of personal finance. They seem harmless, even helpful, but in reality, they are a trap designed to keep you in debt as long as possible. Every time you pay the minimum, you're not reducing your debt, you're extending it, feeding it, and making your lender richer while your financial freedom slips further away. Here's the truth. Financial success isn't about making the minimum effort, it's about making intentional choices that move you forward. When you commit to paying more than the minimum, even by a small amount, you take control of your money. You accelerate your debt payoff, save thousands in interest, and free up cash for things that truly matter, like saving, investing, and building wealth. The difference between someone who struggles with debt for decades and someone who achieves financial independence often comes down to habits like this. So don't settle for the minimum, because you're capable of so much more. Take charge of your credit, take control of your money, and make every payment count toward your future, not your lender's profits. If this video helped you understand the danger of minimum payments, hit that like button, subscribe to Smart Dollar Mindset, and share this with someone who needs to hear it. And don't forget to check out our other videos on credit, budgeting, and investing for more strategies to build financial freedom.